Hello and welcome to Weekend Investing Daily Bytes. Today's episode, we're shooting episode 188 on 2nd of March. Again, another day where external cues were weak and the market opened gap down, and it does not seem to be ending anytime soon. This global uh, issue with the Russia-Ukraine war, and that is continuing to have a overhang on the markets, both in terms of the uncertainty of the outcome as well as the fund flows. So the foreigners have been continuously selling out, and the oil price, which is Brent, is above 111 today. That is definitely going to impact several economies like India in a very big way. And of course, within the market, several stocks are getting hit because of potential oil prices. Commodities are running, inflation is definitely ticking up. So all that has become a very, very uncertain sort of concoction of parameters that nobody really knows how it plays out in the next few weeks or months. Whether this, the war situation comes to an end within a few days or weeks, or does it even expand beyond these two countries? So there is a whole host of possibilities that is there. So coming back to the markets, as I said, markets were down, gap down, but in the last hour, last 30 minutes in fact, there was a good pullback in Nifty. Metals were still running very, very hard today. Metal index is up 4%. Today, for this week itself, it is up 9.4%. It is the best performing sector in the last 1 month at plus 6%. Best performing sector in 3 months at plus 13%. And best performing sector in the financial year now, plus 54% for the financial year. Public sector enterprises, energy stocks, commodity stocks were also in green, but autos, banks and pharma and even real estate were pretty much in the red, and it has been so for the last week, month and also 3 months for most of these sectors. So a very, very mixed bag sort of situation where IT and FMCG is sort of was range bound, but over a week and month even these defensives have given up some ground. Nifty closed more than 1% down. CNX 200 at minus 0.8, CNX 500 at minus 0.7. But the good part, if you want to see the silver lining, was that the small cap and mid caps did not fall today, and we had the small cap index at plus 2%, plus 0.2%, I'm sorry. Mid and small cap index was flat, and so was Nifty Next 50. So these three indices were flat, whereas the other three were down dramatically. And this also translated into weekend investing small case performance. We see Mi EverGreen at plus 1.43%. So this is phenomenal performance today, being a large cap strategy along with hedge of gold. So this has done really well, plus 1.4% for this week, minus 1.8% for the month, versus its benchmark at minus 6%, 6.7%. And for 3 months it is down minus 1.4% versus minus 4.9% for its benchmark. So really, really good performance from EverGreen, plus 36% for the financial versus 14% for the underlying benchmark. MI20, a mid cap and small cap series, MI35, a purely small cap strategy, MI25, another small cap strategy, all doing well, nearly about 1% up, and they have recovered all that was lost within the last week, although they are still down based on the month performance. NNF10 was up 0.5%, MI50, ATH, MI30 marginally up, MI ATH2 was marginally down. So pretty much most of the strategies have recovered in the last 1 week, although for the last month most of them are still in the negative. Top gainers in the CNX universe: Aegis Logistics up 13%, Hindustan Zinc, Oil India, Coal India, and MCX. You can see the trend here, you know, the commodity stocks, oil stocks, they're all running very, very hard. And the biggest losers today were Credit Access. Maruti was really down 6%. Minda Corp was down 5%. So autos and auto components have been in the firing line. Dr. Reddy's Lab with its Russian connections, CCL product, all down minus 5 to 6%. Bank Nifty, if you see the yearly chart, is at the very edge of, you know, this support trend line that we have, and I think on close it has just recovered to this trend line, so it remains a very tentative at a very tentative position here. So one should look out for falls below 35,000, and it may really precipitate 1,000 or 2,000 points very, very easily if there's any external shock. Another chart that I posted today was the comparison of gold performance versus Nifty performance, and you can see that these are two ETFs, Gold Bs and Nifty Bs from Nippon India Fund, and you can see that from January of this year, gold is up about 6.5% and Nifty is down about 9%. So very, very complementary hedge that gold provides to equity portfolios, as I've been saying all along. So this I just wanted to show you how things, and that is the reason why EverGreen and other strategies like that are performing well, because this is the complementarity that exists because of gold being an asset which does well when equity is not doing well. And this is again, as I highlighted, you know, EverGreen was up 1.4% today despite where the market was. So the power of hedge is tremendous. Another insight you can say was that we looked at HDFC group stocks. So HDFC Bank, HDFC AMC, HDFC Life, and HDFC Limited. We see that most of the HDFC group stocks, of course, these are fantastically great quality companies, no doubt about it, and almost all of them are richly valued as well. So what we are seeing here is that from the pre-pandemic area, you know, so March or Feb of 2020, in the last 2 years, HDFC AMC is down 36%, HDFC Life is down 5%, HDFC Limited is down 5%, HDFC Bank is doing slightly better at plus 10%, versus Nifty at 37% from the same place. So all the group stocks of HDFC have underperformed Nifty in a very big way. Of course, this is nothing to say that, you know, they will not outperform in the future. I have no way of predicting that, but it is a fact that in the last 2 years has been poor performance by this group companies, and one should not blindly just follow the quality names or the big names, because performance is another dimension which may or may not happen for you despite holding quality. So this is something that one always needs to look out. Another insight that we had today was to compare gold and gold ETFs. So the blue line at the top is the gold price, and I've taken the change in gold price since 2 years. So again, from pre-pandemic, you can see that gold is up 23%. And one would think that the gold ETFs that are available there are about 8 or 10 or 12 ETFs there, would not lag as much as what we are seeing here in terms of the returns. But when gold price has moved up 23%, most of these ETFs have done between 13 and 16%. So a huge gap in terms of performance that has slipped through either in expense ratio or tracking error, because there is no other way to explain this. And gold being a very sensitive to price commodity, 3-4% type of variations in a year, they are not digestible. So I am a bit disappointed that these ETFs have performed the way they have, and as an alternative for long-term gold holders, I would say the sovereign gold bonds are a much better bet, based both on taxation angle, based on the 2.5% additional interest you get on that, and of course the sovereign counterpart guarantee on that. The only downside there is the so-called liquidity issue, which usually is not so bad for retail investors, but there is a discount that is there in the markets on those instruments. So if you are a long-term holder and you're going to hold to maturity, there is nothing that can beat sovereign gold bonds in terms of the features and performance. But if you are a short-term holder, and we use ETFs in Mi EverGreen also, because we need to keep changing that allocation. The allocation went from 25 to 27%. We have to bring it back to 25%. So we need that liquidity. So hence we use the ETFs. But for short-term holders or traders, ETFs remain the best bet in terms of exposure to gold. So this was the view on gold ETFs and sovereign gold bonds on that. So I hope you're liking whatever little content we are able to share with you on a daily basis, hoping that this will educate you in improving your own performance and understanding in the markets. So thank you so much, and I'll see you in another video. Bye.